S&P earnings is the $1 million question. And the street thinks that they're going to grow 8% in 2022 and 8% again in 2023. And then so what I do is I have to do two things. Try to figure out if something leads that, like what Mike was saying, and figure out if those forecasts are above or are too rosy or too pessimistic. And then also, in so doing, figure out what do I want to be bulled up or on relative to something else inside that stock market. So I have two things I can easily get wrong. Now, it seems to me that those earnings are going to woefully disappoint. Certainly maybe next year, because there's got a little bit of a lag effect between these tightening lending standards that I'll mention to you guys. And then as those disappoint, I need to, as a stock market, sell something. And that thing that I, as the stock market, have been selling in 22 is discretionary in tech. Now, maybe it's because the disappointment is coming out of utilities and staples, but that doesn't make much sense to me. That a situation where earnings are just fine in those sectors, but the utilities are laying an egg and staples are laying an egg. So why do those disappoint next year? Well, I've got a couple leading indicators that I think are plain as day. One is, it's kind of like, let me think of an analogy. Maybe I don't have one, but if I ask you, how was the weather on Friday over at the beach? Well, it's like January. It's going to not be good on Saturday, but it was August. And so it's hot and then hot again. Well, okay. What are we doing with the S&P 500? We're gauging the health of big business. So one way I can figure out whether or not big business is healthy or not is maybe I can ask a bunch of small businesses, because it's kind of correlated. It should be highly correlated, like a 0.9. So we have measures on small businesses. It's the NFIB survey. National Federation of Independent Businesses are serving like a laundry list of businesses. And then they ask them this laundry list of questions. And the question is, what do you anticipate your sales are going to be like in the next 6 months? What do you anticipate your earnings are going to be like in the next 6 months? Or your earnings right now, or your sales right now, or your availability for credit, all these things that they ask them. And they ask them about earnings in the last 3 months. And I think the data series is 1985 to present, and it looks like a bungee cord. So that's the NFIB. And then you overlay that with the year-over-year change in the S&P 500, and they look like they look like they're tied at the hip. That's one of them. And then the other one is you can take a look at the New York Fed Senior Loan Officers Survey, which seems to me to be in direct alignment with, help me guys, somebody throw me out a 10-year T-note yield, 3.3, 3.4?
Yeah, call it 3.4.
Okay, let's call it 3.4. And then let's call a mortgage rate 6. Some people are saying 6.25. Some are, whatever. Let's say it's 6.
6.25, 6.
Okay, let's go with
Treasury.
6.
Treasury is at 3.45.
Okay,
and the 30-year mortgage is at 6.02.
All right, 6. Okay, 6 minus 350 is 250. Okay, so 250 over. When normally it's like 150 over. So we have tightening of lending standards in that one part of your loan book, mortgage lending, corroborated by what did the New York Fed Senior Loan Officers Survey respondents say? On net, 14% of them said, across my entire loan book, I am tightening credit in the third quarter, which is a fresh data point because it's third quarter. And then boom, overlay that on year-over-year S&P. This is what I was doing when I was 25 years old. Like, hey, kid, here's a Bloomberg terminal. Find something that leads something else, and we're going to put it in the chart book. That's like what I did that's what I do all these years. And it's saying S&P earnings are going to lay an egg. So, it's like, well, I'm from a value shop. That's good news for Wisdom Tree, because I think it means, if this stock market 38, 3,900 on the S&P, and if it goes down to 34, 35, whatever it goes down to, I don't know, maybe it goes up. Seems to me that the street will have to do two things. One, it will have to revise those earnings growth projections down, which you do need to account for. Maybe we already know that. That's part of it. It's kind of like the unwritten rule on the street that they always kind of revise them down. But are they revising it down from 8% growth to 3 or 4% growth, or to red ink? And in that case, what are they selling? I would think they'd be selling something like the Russell 2000 growth, small cap growth, which is like 28%. What is it? 28% by market cap negative earnings.
Yeah,
So
long duration assets that are going to get
bingo, long duration assets. And I'm probably running over your time here because, as we just talked about, 345 on a 10-year, call it 3 3/4 on a 2-year. It doesn't make a whole lot of sense for these stretched type, give it to me at zero interest rate policy type assets. Suddenly you can talk about utilities and not get laughed out of the room. That's what this market is giving us. It's because of leading indicators. So that's where I stand.
The other thing, Jeff, is pricing in the fact that, as you alluded to, Rodrigo, earlier, okay, if we're going to have positive real rates, are we going to get to 2% inflation where a 3.5 10-year is the right rate? I don't think we are. And if we get the long run rate of inflation being 3.5, that's 5.5% yields, or 4.5 to 5% in order to get to a real yield. So now we've also got these long duration assets with falling earnings yields that have to have further discounts to their cash flow imparted to them to make it attractive enough longer term to buy those assets for a return. Like it's not just the inflation, and then a further discount has to occur because the volatility of the inflation that we're facing is an order of magnitude wider, right? The distribution of outcomes here, and this is I think a really good point here. We're talking about a lot of uncertainty, so everyone should realize that a lot's going to happen. A lot we're talking about, none of it's probably going to happen, but some other stuff is going to happen. But what we can say confidently, I think, is that distribution of outcomes has much fatter tails and is a much flatter distribution, and we have less certainty of the outcomes. Contrast that to the last 30 years prior to December 31st, 2021, where rates were coming in, inflation volatility was squeezing, allowing you to pay more and more for those longer and longer duration assets. We are now unwinding that. On top of that, the potential contraction in earnings yield.
Ooh, let me run with something here.